John has a quick question. What's the smallest DSCR you can do in Minnesota? You 50,000 usually. We have one company that doesn't necessarily have a
The
limit.
problem more, John, is the cost below 100 for them can
Is like
sometimes
significant.
make them, yeah.
Yeah, they'll balk at it, and they'll want us to cut compensation and fees and all stuff. And at that point, we don't make very much
Yeah.
money on those anyway.
Yeah.
So,
Yep. But we're happy to chat, John.
uh,
Taylor on our team
mm,
is kind of our DSCR and commercial specialist. Um, non-warrantable free and clear. John, reach out. Let's chat about it. Let's see if we can
yeah,
help.
okay, it's fine. Yeah, that's not that low.
Yep,
I'm from
yep.
Kansas. I'm from Kansas. Low to me is like 50. You know.
Which, by the way, we have a new realtor partner that Mike is getting set up in your neck of the woods, Kansas and Missouri, and
Okay.
is excited to work with us. John, I'll grab that and drop it in the chat here, or shoot me an email. That might be easier. Then yeah, and I'll make a note here, John Mazzara. Okay, with that said, we're gonna get rolling with our topic today, which is 5 little known facts about FHA mortgage financing. A couple of housekeeping items. Jordan, just so you know, I actually made a couple of slides for this.
Oh, okay. All right, cool.
A couple of housekeeping items before we actually dig in to the topic. Number one, this we've set this up so that it's on demand replay immediately after we're done. So if you might be watching this live or you might be watching it after the fact. Regardless, you can do that through Zoom. We also take the recordings, we add them to our YouTube channel, Wake Up Real Estate, and our website, wakeup.realestate as well. I've got my contact information, Jordan's contact information. Sorry, John, I don't have Taylor's on here, but as we dive in here, I will certainly share that. And one of the reasons why, well, there's a bunch of reasons why I wanted to dig into this topic. Jordan and I actually, I think it was last summer, we
Yeah, a little
held
over.
this info session. But I think it's as we head into the spring season, there will be some good reminders here that maybe can help you find opportunities that you might be overlooking in your existing database, your existing sphere of influence, etc. You're having conversations if you're out at sporting events or school events or whatever, just to have that reticular activating system on and find those opportunities. Before we get in, though, to the 5 little known facts, Jordan, maybe just big picture, talk about why FHA, even for someone who qualifies for conventional, at least for the borrower, is generally speaking a better option right now.
Yeah, absolutely. There's a couple of different reasons why, but the main reason is going to be mortgage payment. Okay. If you're comparing, especially since FHA recently cut, when I say recent, now it's been like a year, but
Yeah.
they recently cut their mortgage insurance requirement for FHA.
Yep.
It ended up cut it to 0.55% versus the normal 0.87, 0.85. And essentially pricing is usually about 1% better on rate for rate compared to a rate on conventional. So if I'm at a 6.625 on FHA, typically I'm at a 7.625 on conventional. So all around, that is that's probably the number one reason is payments usually significantly less. Okay, even with 20% down, avoiding PMI with conventional, a lot of times even with you're still at a better position to do an FHA home loan. The second reason is we're in a declining market on rates. Okay, as the rates are declining, there is such a thing called streamline refinances. So this is a big kicker for clients. So when I'm having conversations with clients about not wanting to move forward because of interest rates and what the market's doing. Like if I'm taking a perspective of how do I come over a rate objection, as a realtor or a loan officer, the first thing that you can bring up is streamline refinances. um, Streamline refinances essentially is a I think for some reason you're logged in as me, Carolina. So
I don't know how that happened.
uh yeah, you can hide
I
me,
don't
that's
know what
fine.
happened. Sorry.
No, it's fine, you're good. So basically, uh on that rate objection, a lot of clients will not want to proceed forward because of their interest rate. It's being too high. Well, when you talk about streamline refinances, you don't have to do an appraisal. You don't have income verification. It's as long as the interest rate's dropping more than 0.5%, you can refinance to a better rate. So we'll use the term a lot: marry the house, date the rate. When I'm talking to clients and I'm trying to pre-approve them and I'm trying to ease their concerns about buying in this current market, because as everyone knows on this call, is as rates drop, the demand's going to go up, and we're going to go back to a 2020 vision of what's going on in the market. And the more people that we can get into homes now, the better. Probably they're, the less they're going to pay in the long run, because they'll be able to use that streamline refinance and get into that lower rate. And it won't matter whether, what happens if the market crashes or anything. They can drop that interest rate. So a lot of times I'm quoting people a rate, today's rate, and then what we expect it's going to be in the next 12 months.
Which is just, listen, it's just a projection. We can't guarantee you anything, but just the fact that we're proactively having the conversation about the idea that these streamlined refis exist. Most people don't even realize that, right? And I know this is very obvious, but if you purchase a house, you can't go back and renegotiate the price you paid for it, but you can renegotiate the interest. Okay. So that said, we're going to start to dig into our 5 little known facts. One thing I didn't mention in our housekeeping is, if you have questions or scenarios, or you would like us to repeat something, whatever that may be, just drop it in the chat, or even in the Q&A box. The chat's a little easier, but either one is fine. And if it is relevant right then and there, we'll address it. And if not, Jordan and I are going to hang out until the end, or until everyone is able to get their questions answered and any scenarios addressed as well. So let's start with an easy one, Jordan, which is credit score. Credit score requirements for FHA.
I want to preference this first. If you're talking to any good real estate agent is going to have more than one lender in their wheelhouse that they're working with. Okay. But with that being said, a lot of lenders will have overlays in this credit score, section. They'll essentially either be capped out at 580 or 600. They won't go any lower than that. In reality, FHA goes down to 500. Okay. Anything
Repeat
below
that, Jordan.
In reality, FHA goes down to a 500 credit score. Yeah. So I've probably done 3 home loans in the last month and a half, 2 months, that are probably 520 to 550 roughly.
This
not
calendar
including
year,
refinances.
we've done
in the last
3
month.
this calendar year. Below
So
580, above 500, below 580.
It's actually easier to get someone qualified at like a 550 with 10% down first, because anything below 580 requires 10% down, but it's easier to qualify someone at like 550 with 10% down than it is with someone 580 at 3.5. I don't know why. I think it's more skin in the game. So, the system will take them, but essentially anything below 580 is going to be 10% down. Anything above 580 is going to be 3.5, the requirement. That's, neither here nor there, as long as automated underwriting will still accept them. Basically a system we run saying yes or no. But the likelihood, with 10% down is much, much greater than 3.5. Like we just closed one that was 523, for example. and it went off without a hitch. So
So I want to reiterate this. So from 500 to 580, they need to have 10% down. 500 to 580, they need to have 10% down. 580 plus is 3.5, though you may have talked to in the past or may talk to in the future a lender that says, oh, 598, sorry, we can't do that. And that is an example where that lender has an overlay, additional criteria that they've added to that. Jordan, how many lenders do we have approximately that'll go down to 580 on a 3.5? It's at least 3, right? Maybe 5?
No, we have about 20.
Oh,
20
okay.
to 5 to down to 580. But anything below 580, we have about 5. So there's about 5
Okay.
different lenders that would allow to go down to 500.
And this is an aside, this is not part of these 5 little known facts, but one of the benefits of working with us or a mortgage broker is the ability to go and shop for the best deal for your client. So at NEXA Mortgage, we have over 200 wholesale lenders that are competing for our business every day, and we have over 4,000 private hard money commercial lenders, which means in many cases we have more options or a better chance to get a deal done where if the scenario is a little bit sticky, let's say, or outside of the box, or doesn't fit, the nice, easy qualifications. And in fact, for those of you that were on at the very beginning, I was talking about a new realtor partner that is excited to work with us. And one of the reasons why is the main lender that he's been sending deals to, they just don't want to work, and their overlays are making it such that folks that he is confident could and should qualify and be able to get pre-approved, they're just throwing their hands up and not even bothering. And so, if you're experiencing that, we would love to chat and see how we can help. So that's number 1. Go ahead, Jordan.
I'm getting a phone call. It might be them. Go ahead.
Okay. So that's number 1. Number two is the idea or the little known fact that you can actually have multiple FHA loans. You can actually have multiple FHA loans. Now, there has to be extenuating circumstances, and you have to be able to justify this. You have to have justification for why to make that happen. But here's an example of how that can happen completely legally, ethically, etc., and compliantly. You have you're working with a young couple, and you help them buy their first home. Maybe it's a little townhome, maybe it's a little starter home. It's a 2-bed, 1-bath. It's a 2-bed, 2-bath, even a 3-bed, 2-bath, something along those lines. And after a year or two's time, that couple, I don't know, maybe they've had twins, or maybe they've had a situation where they have to bring home one of their parents to take care of them. Could be any number of things. As long as you can justify why you need to trade up into a larger home. Maybe you were in a townhome with no yard. We need a yard. We need another bedroom, etc. As long as there's justification for that, you can actually buy another home with FHA financing. So you could keep, or those clients could keep that first property. They could hang on to it as an investment property, and they could use FHA financing to purchase. Maybe it's a new construction, 4-bed, 2.5-bath. Maybe it's a pre-existing, a pre-sale or a resale rather. But as long as they can justify it, and Jordan, as long as they've been in the first home for at least a year, is that right?
Yes. Yeah, 1 year.
So they have to have been in the first home for at least 12 months. And as long as there's a reason, another reason that I didn't even mention is maybe they got a job transfer. Okay. Mm-hmm. Maybe they got a job transfer. They can keep that first property and, start their investment portfolio if they so choose with the existing FHA financing, FHA mortgage on it. And we can go and get them another FHA loan for the next property.
Mm-hmm.
And Jordan, what was the most? I can't remember. How many? You had a client that had how many FHA
Eight,
mortgages?
eight, eight.
Eight.
Yeah,
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 for those
eight.
that missed that,
Yeah.
eight. Now there were some other extenuating circumstances with
Yeah,
that,
that was a
right? That
very
was
unique scenario.
Mhm.
But I'll get to it. One of the you can co-sign for as many people as you want as well, right?
Yeah.
So it's not. So let's say you have a brother or a sister, you have to be family when you're co-sign. Just so you get, everyone knows when you're co-signing for an FHA loan and you're a non-occupying co-borrower, you have to be related, okay? Or it's like I think it's 25% down. There's something that's too much that will throw you for a curveball.
Right.
I'll double check that, but he had brothers and sisters that he co-signed for. You can co-sign for as many to help them get into homes essentially.
Yep.
The another reason would be if let's say you and mom moved into a house, right, and you bought the house together, mom and a daughter or a son. If the son decided to move out and buy another house, and one borrower is staying, that is another instance where you can get another FHA home loan. You don't have to refinance that home loan. And then obviously, divorces, separating, and other things like that. Regarding separating a house, you can have technically two as you're going through that transition.
To keep it simple, at least 12 months and a real reason why.
Yeah.
Um,
Mm-hmm.
at least 2 months. But that can be a great strategy for, and maybe that becomes your specialty as a real estate agent. You help first time buyers, and ultimately, like your long term plan is to help them build an investment portfolio. And that's part of your strategy. Hey, let's start with a two bed, two bath townhome, or little Cape Cod or something like that. And when you guys are ready to start a family, we can keep that property in place, turn it into an investment property, and trade up into something else, and still have the 3.5% down in play, depending on credit score, obviously. So hopefully that makes sense. Little known fact number 3: low down on multifamily. Low down on multifamily. What do you got on this, Jordan?
Well, this is a common one that is promoted a lot. It's not as great as it used to be because conventional now removed their 15% down requirement. That it's actually lower now for conventional, so it's low as 3% and 5% down. But 3.5% down, to down payment assistance as well, right? FHA typically, I don't do we have a slide on DPA? Oh,
We do. It's the
okay.
last one. You
I'm not
let the
going to
cat
deep
out of the
dive too
bag.
deep in it, but essentially, you could have no money down on multi unit properties, and get in there on an FHA home loan.
Yeah.
So up to 4 units. Anything past 4 units, even conventional is not going to work. So
Right. So again, going back to the slide before, that may be another strategy where, and this is a wonderful strategy if you have children who are, getting ready to buy their first property, buy a 2, 3, 4 unit where they're going to live in one of the units. And when they're ready to trade up, or if they wait 12 months, that becomes a great reason why they are going to use another FHA loan to purchase their next property. Okay, I'm sick of I need some more room than the 1 bedroom apartment that's part of my multifamily that I purchased, or my 2 bedroom apartment. And so 3.5% down is in play, and DPA, which is in play, which are number 5, little known fact number 5. We'll dig deeper on DPA. John, to your question here, I know this is a little off topic, but are you licensed to do loans in Minnesota? I have a YouTube channel where I interview people in our industry. I think this would be great content. We would love to. John, whether it's
yeah, I'm
both of us
licensed
or
in
just
Minnesota.
Jordan, absolutely. Yeah. That would be great, John. So I'll make that connection after the show as well. Oh, I was wrong. It's number 4, not number 5. So
Okay.
I kind of combined these two. Number 1 is $100 down HUD homes and down payment assistance, which means
I think we should probably talk about all the different down payments.
Okay,
This
perfect,
this
perfect.
kind of
So
wrap this
let's
all
so
together.
really I should have made this two different slides, to be honest. Let's first tackle the 100 down HUD homes. Maybe somebody has heard of that before, maybe they haven't heard of that before. What is that? Where do I find those? How does that work?
Uh, HUD foreclosures are not as common as they used to be,
Correct.
but especially I know some of them are getting out of business now. Like HUD is getting out of certain things. So any HUD home doesn't necessarily have to be a foreclosure. I know I think it's Wichita. They are selling a lot of their Section 8 housing that they have,
Okay.
public housing, and that would be considered a HUD home, right? But a HUD home is just anything that is being sold by HUD, FHA, essentially a foreclosure, anything, right? Could be given a deed in lieu, you name it. And technically, there is $100 down HUD program that is no different than a 3.5% down, program. It's all the same requirements, nothing different. The only thing unique about it is you're buying it from HUD, and you're going to have to, from a real estate perspective, you're going to have to request utilities. If you've ever bought a foreclosure before,
Right.
there's a couple extra some paperwork that you're going to need to fill out.
There's a
But
little more red tape.
yeah, a little more red tape to get utilities turned on for the appraiser and timing and some other things. But for the most part, someone could theoretically buy a house to move and live in it for $100. And I have in my past, this is probably 5 or 6 years ago, where I had a client bring $100 to closing because the bank paid their closing costs. So it is theoretically possible, and it is something that gets just as good pricing. There isn't a hit on the pricing at all, from difference between three and a
There's
half
no
and
gotchas or
yeah, it's pretty straightforward in the terms of what they're allowed. I would say if I was going to say a gotcha, the only gotcha you got is a lot of times these are hard for any small HUD repair fixes, which that would get us into a different conversation on 203B
that is
escrows.
number five. That
Okay.
one's number five.
Yeah.
Yeah.
All right. All right. So, but yeah, HUD. Yeah, it's HUD homestore.gov.
HUDhomestore.gov, you can search for them. But again, they are few and far between. We actually were talking about this on the Wake Up Real Estate show one day last week. Ryan brought it up, and there were like 37 in the entire state of Florida, which is not a lot, but
There
it,
used to be a
it
lot
doesn't.
more
I
than it
mean,
used to be, but yeah,
yeah.
I
And,
don't
and
know.
that could change. That could change. Um, and also, it's not just these, I believe, are the foreclosed ones, but maybe something like what you described would be on this list
This
as
is something
well.
that's new. I don't know. I thought I heard through grapevine in the real estate office I sit in that a bunch of HUD homes are coming on the market to be sold because they're getting out of the real
Hmm.
estate, housing.
Okay.
So
So that's the HUD home, $100 down HUD home. Uh, Little known fact. What about down payment assistance?
So down payment assistance is going to be far more available on FHA loans than
Yep.
conventional loans. I think we might have one product that allow for conventional. 99.9% of all other DPA products are going to be tied with an FHA home loan. So it's still the standard FHA 3.5% down home loan. It's just you're attaching either a silent second or a forgivable grant or maybe a state specific grant with that home loan to cover their down payment or their closing costs. And this can range, yeah, I'm not going to get into all the products that we have for down payment assistance,
Well,
but
actually, let's do this, Jordan. Hey, Mike, can you grab the link? We actually did an info session like this just on down payment assistance. So, Mike, can you grab that link and pop it in the chat here? Because I do think the chat populates even on the on-demand replay, so folks will be able to see that. And Mike, let's also make note to include that one with the replay of this in the description so folks can easily find that. Instead of going into all of them, Jordan, let's
yeah.
talk about your favorite and why it's your favorite and how that can be helpful to those on here.
We have a company that has a nat no so let me back up here. Let me kind of explain the generality of most grants or DPA products. 9 times out of 10, when you have a local grant or a local DPA, one, it's local, right? It's local to that state. So, which doesn't really pertain a lot to realtors because usually realtors are local, but lenders it does, from a mass standpoint. But number two, you're also going to have restrictions 9 times out of 10 on income, areas they can buy in, uh credit, certain credit score, requirements, and the products that,
Almost like overlays
yeah, they're
with FHA
overlays.
lenders, kind of.
Yeah. They might have a 680 credit score requirement, but also they can't make more than $50,000 a year. It just depends on the grant and what grant that you're trying to give, or what DPA product that you're trying to give. And a lot of times they'll have what is called a silent second. Okay, so it's like, hey, this is a grant, yes, but it's a silent second for the first 5 years, or you got to pay it back. But essentially, when you're doing that silent second, you're basically locked into that home loan for the next 5 years, or you have to pay it back. Okay. So what I look for is for a least amount of restrictions and something that's forgiven on day one. Okay. Especially in the market that we're in. We're in a declining rate market. Most clients are not going to have these home loans for the next 30 years. They're going to have it for the next 12 months or 24 months. So we want to set them up for success. We want to set them up for to position themselves to get a better interest rate, because these interest rates are also heightened. There's no such thing as a free lunch when it comes to DPA. There's less skin in the game. It's going to have a higher rate. So the product that I like the most is a forgivable DPA on day one. Okay, with no income restrictions at all, and it's national. Okay, so it also allows it, not necessarily, there's three options for them to qualify without having to be a first-time home buyer. Okay, one of the options is to be a first-time home buyer, and they would automatically qualify for it. Number two is to have an median income of 100% of the median area or below. Okay, and number three is to be over 62 years old. Okay. So this one is by far the most range of the most borrowers, to where it's not just first time home buyers, but it opens up to other people as well. There is no income caps. So if they make $200,000 a year, you can still get a DPA program as long as the FHA loan limit isn't broken, which is like, I want to say in a lot of areas of 500,000 at this point. I think it's 500,000.
It's 494 or something like that. I
494.
think is the lowest. I think is
Yeah.
the lowest,
It
and
just
in some
updated.
areas it's up to
Yeah, it's
almost
a
700,000.
million. Yeah. So think about it that way. You have a client in California with an income restriction. A lot of times they're not going to qualify for most grant programs, of those sorts. This program would allow you to, because there's no income restriction, and FHA goes to a higher amount in those areas. So it opens up to states that normally wouldn't, that have high price points as well. It opens up to those states that allow them to do that. But the grant itself, what I enjoy the most about it, it's forgivable in day one. There is no second mortgage lien. There's no resubordinations. Which takes extra time in the loan mortgage process, where a lot of people say, hey, I need to do a grant, but I need 45 days. The reason they need a 45 days is they got to reach out to the grant, get the money settled, put it in assign it as a second lien on the property for 5 years. There's paperwork involved in it. It's like closing two mortgages at once. And at the end of the day, this grant's not like that. We don't even put it in as a subordinate lien. It's a gift in the asset section. So it's a
And if
solid
you
product.
said this, I'm sorry, but it's 5%.
Yeah, it goes up to, it can go up to 5%.
Go up to
Three and a
5%,
half
which
percent is much more reasonable for the client in terms of rate and things like that. And a lot of times it's it's not that much far off from the 5 on pricing. So a lot of times as when we're talking to the client, we go 3.5 purposefully, even though 5's available.
yeah. And two, this has kind of come up twice. This is a bonus little known fact. I mean, actually, this isn't little known, but this is just a good reminder. With FHA offers, you can request as the buyer agent up to 6% seller help. Now, we get it. We're in a low inventory environment, and in a lot of cases, competing offers, etc. But it still is happening. We have clients under contract currently that have gotten seller help. Maybe not the full 6%, but Jordan referenced earlier, he did have a client who bought $100 HUD home, and the bank even paid the 6%. So it is possible. It doesn't mean that it's probable, but it's possible. It's all about what you can negotiate and make happen. So, all right. Number 4 was $100 HUD homes and DPA. Number 5, we hit this very, very briefly, but FHA financing to do renovations and or rehab. What does that look like? How does that work?
I don't want to start. So on a side note, background on me, when I got into the industry 11 years ago, I asked my mentor, what is the hardest loan you could possibly do? And I want to specialize in that because I thought I would be a niche. So I specialized in renovation loans with FHA conventional loans.
Yeah.
They are hard to do, but once you figure them out, they're not too bad. But essentially, there's really, I would say there's 3 main products when it comes to renovation loans that you have to be aware of with FHA. 4, let me clarify. 4 main products. The traditional ones that most people hear from is the 203K. Okay.
Right.
So you'll hear a lot about the 203K, what it could do. I mean, essentially on a full blown 203K, there's a ground up construction for additions and other things. But let's say we are, we want to break up 203Ks into 2 categories. You have a limited 203K, and then you have a full blown 203K. A limited 203K is like you're wanting to put lipstick on a pig, right? It's basically, cosmetic items. It's not anything that's large. You're not changing anything structural. You're not doing a full blown rehab. It's anything that's less than $30,000. More than $5,000, less than 30 grand in renovations. Okay.
And we say lipstick on a pig, like a wonderful pig. A
Yeah,
pig
it could be it could be a nice
yeah.
pig, or but it could, so ticky tacky, items, cosmetic stuff, things that wouldn't pass FHA, financing, but it's a little too much to come out of pocket, right? And it's too much for the seller to come out of pocket. Things like that. Or maybe it's like the house is a little outdated. They want to redo bathrooms and, a kitchen. They could do all that at once as they buy. These products do take a little bit of longer time. I would usually ask
more red tape, like more.
It's not that it's necessarily red tape. I would say it's more or less rounding up contractors are very difficult to do, especially contractors are not paperwork people. And the last thing I want is to put that on you guys. We're salespeople, whether it's not loan originators and real estate agents are salespeople. I put it on the client to round up their contractors. It is way too much work for either the originator or the realtor to tackle themselves. It's a lot of paperwork. Every draw, everything is going to be essentially have some sort of paperwork this contractor is going to need to fill out. And that's usually what makes the loans half the time difficult is rounding the people that you needed to do. But that is the limited one. The limited one also doesn't have what is called a HUD consultant. What a HUD consultant is basically someone that's going to babysit that contractor. And yes, I've had people get into arguments and fight and walk off jobs because of the HUD consultant and the client not getting wrong. So you got basically 3 people trying to run a project at the same time with their own opinions. Okay. So keep that in mind. So the limited is much more preferred if you can do it, because you don't have that third person involved. The full blown 203K, you do have that HUD consultant involved, but you can do as many repairs as you want. I've done $150,000 remodels as long as the property appraises for the remodel, right? It can't come in and, be worth 200 grand and after the, renovation value and you're trying to dump another 100 grand into it. It's just not going to work that way. Okay. That is the most common ones that you're going to deal with. The not so common ones are going to be 203B escrow Okay, escrows. We talked a little bit about HUD foreclosures before. HUD foreclosures, they allow you to do some renovation work on them by doing a 203B escrow. It's essentially a product that is going to allow them to do the repairs required on a property. If it's just too, a lot of times you can't touch those properties. So if there's needing to be a railing installed or anything like that, you can essentially remodel the house, but it's allowed on every property. So that's a HUD foreclosure. So even if it's not something that is necessarily a requirement by HUD, you do have the ability to roll $5,000 in and remodel the property up to $5,000 in combination with the $100 down.
Yeah.
It doesn't have to be. It's just in addition to that. But yeah, that's the only solve for anything less than $5,000 worth of work, right? Anything over on renovation loans has to be more than 5,000 on normal houses.
Okay. So to summarize, number one, credit score 500 to 580, 10% down is in play. 580 plus, 3.5% down. We will say flat out 580 to 640 is still tricky to get approved, but we do it frequently. It's just it can require some creativity, and Jordan's very good at that and knows the guidelines very well, if you can't tell already. Number two, the idea that we can have multiple FHA loans as long as we've been in the current home for at least 12 months and have a legitimate reason why. There could be any number of reasons why. We went over those. Low down on multifamily. Okay, that's a great option. 100 down HUD homes and down payment assistance and the renovations and rehabs with FHA. All of that said, what questions or clarifications or maybe myths or other things from all of you, maybe even a scenario that you would like to run past Jordan or I, really Jordan, because he is the guideline guru here, that we could jump into. And as we're waiting for those questions and comments, my contact information and Jordan's contact information are both on the screen. The QR code bottom left will take you to where you or a client can go and create a free account and get started with an application. And top right is a short overview of our dual license program or opportunity where you can be dual licensed mortgage and real estate agent and actually get a referral fee when you send us a client. We did a deep dive on that last week or 2 weeks ago, which if you're interested, I'd be happy to share the deep dive on it as well. And I'm talking with several folks a week, quite honestly, about that. It does require some work. You do have to get licensed, but it can be a great way to increase your revenue without having to sell more homes. So you can definitely check that out, or you can go to wakeup.realestate/RELO. Jordan, you must have done such a good job of explaining that no one has any questions. So
I doubt that.
we have plenty that we can get back to, but we would love to chat with any of you if you have a scenario that you're just not comfortable sharing openly here, but you'd like to run past Jordan or I. Once again, our contact info, those are our personal cell phones on there, and our NEXA email addresses, which we monitor heavily. You can reach out and we'll get you pointed in the right direction one way or another. Hold on here? There's a Q&A. I missed that. Hold on. DPA programs for educators with FHA loans. So specific, let's say niches, let's say.
There's not really specific niches on them. I'll give you an example. If you're going to get grant money in general, I mean, there's some, let me clarify. There are some programs out there that do help with closing costs. Okay, regarding to like educators and
Right.
firefighters and policemen, things like that, but not down payment. Okay, down payment itself, typically they're grants from either the state or a company, and they're going to go a larger broad. The only other thing I could say that could be for, maybe doctor loans that have less money down, but those are really non-QM loans and very high loan balances. It's not,
Yeah.
it's still like 10% down, 5% down, but they essentially ignore the student loans, the massive amount of student loans they have.
But, and this illustrates another reason why you love that, the one that we default to most often.
Yeah, it's open to everybody. That's the
Yeah,
big thing. It's not, it's
exactly.
for me, it's when I'm looking for a product is how many people can I help, but how many real estate agents in different markets can I help as well? At the end goal, if you guys don't sell the house, I don't, I can't do a loan, right?
Yeah.
So if there's products out there that are limited by state or geographical area or anything like that type of educator loan, if there's a very specific like that, there's probably some sort of limitations on pricing and other factors a lot of times. So I try to go
Yeah.
as broad and general as I can get.
Yeah. And Robert, there's nothing would preclude you from you coming up with your own special incentive program for educators, of which the down payment assistance that we have available is part of. Maybe you have maybe you offer a rebate, or you offer a home warranty, or a free appraisal, things of that nature. Like we'd be happy to collaborate to help create an affinity program for those
So that
clients.
I wanted to mention that is a lot of times on these is we do end up cutting our pricing to make them work for clients.
Yeah.
So what Josh is describing is something that's normal on the mortgage side. It's very normal. And being able to market and creating the program, putting out there, that's something that anybody can do. Absolutely. That's something we can absolutely do. Just putting it out there and marketing it is, you just got to get out there and, put it out there basically.
Yeah. And Robert, again, we'd be happy to collaborate. I'd be happy. The marketing part of this is sort of my area of expertise, and Jordan is the guideline guru, right? So making sure that we keep it compliant, and then take it to where you can use it as a way to generate more conversations and client opportunities for yourself, and like legitimately help folks in your community, right? Wei said, thanks for the knowledge share. Absolutely. So with that, if you have questions after the fact, maybe you're watching this on replay, just another great reason to reach out to Jordan or I. We'd be happy to answer them and get you pointed in the right direction. And we would love the opportunity to get anyone that you maybe are looking to get out for the weekend and look at some houses, get them pre-approved for you, so that you're showing them the right price house and you're not wasting your time or theirs. So reach out. We'd be happy to help. Thanks for spending some time with us here. Hopefully you learned a thing or two, or maybe were reminded of a thing or two that you can use to help more clients this spring, summer, and the rest of this year. Thank you, Jordan. And we'll be back next week.